I'm frequently asked whether it's better to donate cash, stocks, or make a qualified charitable distribution from an IRA. And the answer can have a huge impact on both your tax savings and the effectiveness of your gift. While charitable giving is a meaningful way to support the causes you care about, not all donations are created equal, especially when it comes to taxes. It's crucial to understand the rules and benefits of each type of donation, as the wrong choice could cost you thousands in missed tax savings and lessen the impact of your generosity. In this video, I'll break down the essentials of charitable contributions, explain deduction limits based on the type of asset you donate, and provide a side-by-side comparison of how each option affects your taxes. Be sure to watch until the end to find out which strategy comes out on top. Let's get started. When making charitable donations during your lifetime, it's important to be aware of the various tax rules involved. Firstly, charitable gifts are exempt from gift tax, allowing you to give directly to charities without worrying about gift tax limits. Secondly, the IRS provides income tax deductions for donations to qualified organizations, but the deduction amount and its limits vary based on the type of asset donated, the type of charity, and your adjusted gross income. Different assets like cash, stocks, real estate, and personal property have unique tax consequences. To be tax deductible, your donation should go to a qualifying organization recognized by the IRS under Section 501(c)(3 or other eligible entities. This typically includes public charities like religious groups, schools, and hospitals, where cash donations are usually deductible up to 50% of your adjusted gross income, with a temporary increase to 60% for gifts made from 2018 to 2025 because of the Tax Cuts and Jobs Act. Private foundations, which are often funded by a single source and mainly give grants to other charities, also qualify, but usually come with lower deduction limits. Additionally, some other organizations such as veterans groups or fraternal societies may qualify for deductions in specific situations. The amount you can deduct for charitable donations depends on your adjusted gross income. For 2024, the deduction limits are set at 20%, 30%, 50%, or 60% of your adjusted gross income. Cash donations to public charities, certain private operating foundations, and some government entities can be deducted up to 60% of your adjusted gross income. Be aware of that if the Tax Cuts and Jobs Act expires in 2024, this limit will go back to 50% in 2026. If you donate appreciated property like stocks, real estate, or collectibles to 50% limit organizations, the deduction is generally limited to 30% of adjusted gross income. This encourages donors to contribute assets that have appreciated significantly, providing a double tax benefit, avoiding capital gains tax, and receiving a deduction based on the fair market value. Alternatively, you can choose to deduct based on the asset's original purchase price, adjusted basis, rather than its current market value. This allows you to use a 60% adjusted gross income limit instead of 30%. So you have two options: deduct the full market value with a 30% adjusted gross income limit, or use the adjusted basis for a 60% adjusted gross income limit. For example, let's say you own a stock purchased for $10,000 adjusted basis that is now worth $25,000 fair market value, and your adjusted gross income is $100,000. If you donate the stock and use its current market value, $25,000, as the deduction, you can deduct up to 30% of your adjusted gross income, or $30,000. Donations to private non-operating foundations, veterans groups, or other specific entities have a 30% adjusted gross income limit, whether you donate cash or appreciated property. This stricter limit is due to the IRS concern that these types of donations have a higher risk of abuse or manipulation. Donations of property other than cash or capital gain property, like clothing, household goods, food, or vehicles, are subject to a 50% adjusted gross income limit. This means you can deduct up to 50% of your adjusted gross income for these types of non-cash, non-capital gain contributions. When making charitable gifts, it's crucial to think about the type of property you are donating. Going back to the initial question of whether to give cash, securities, or use qualified charitable distributions, each option comes with its own unique tax advantages and factors to consider. Simple and straightforward, cash donations are fully deductible up to 60% of your adjusted gross income in 2024. This is often the easiest type of donation, but it might not provide the most significant tax advantage compared to other types of gifts. Donating cash is generally most advantageous when you need to quickly reduce your taxable income. Your deduction amount is the actual cash amount donated. When donating property, it's important to understand the type of asset, whether it's ordinary income property, capital gain property, or Section 1231 property, as this affects how much of your charitable contribution is deductible. Ordinary income property refers to asset that, if sold, would generate ordinary income instead of capital gain. This category typically includes business inventory, artwork created by the donor, short-term capital gain property, assets held for a year or less, and stock and trade or other property primarily held for sale to customers. If you donate ordinary income property to a qualified charity, your deduction is limited to the lower of the property's fair market value or its adjusted basis, usually the cost basis. Imagine you own a business and donate inventory valued at $10,000 to a charity with a cost basis of $6,000. Since this is considered ordinary income property, your deduction is capped at the lesser of fair market value, $10,000, or the cost basis, $6,000. Therefore, you can only deduct $6,000 on your tax return. Capital gain property includes assets that would result in a long-term capital gain or Section 1231 gain if sold. Common examples are stocks, bonds, or mutual funds held for more than 1 year. Investment real estate not held primarily for sale. Art, antiques, and collectibles held for more than 1 year. Donating capital gain property offers a double tax advantage. You can deduct the property's fair market value if you've held it for over a year, and avoid paying capital gains tax that would apply if you sold the asset. This makes it one of the most tax-efficient donation strategies. For example, if you donate stock worth $20,000 that you originally purchased for $5,000, you could save $2,250 in capital gains taxes if you fall into the 15% long-term capital gains tax bracket. For individuals aged 70 and a half or older, qualified charitable distributions from an IRA can be a tax-smart way to give. Qualified charitable distributions up to $105,000 per year can be excluded from taxable income and count toward your required minimum distribution. This is particularly advantageous for those who do not itemize deductions. By making a qualified charitable distribution, the donor not only reduces their taxable income, but also potentially lowers their Medicare premiums and exposure to the Medicare surtax. Now, let's dive into a comparison of how various donation types, cash, securities, or a qualified charitable distribution, can affect both tax savings and the effectiveness of charitable giving for a couple named John and Jane. John and Jane is a working couple in their 70s, earning most of their income from wages with additional income from dividends and both short and long-term capital gains. They also have a required minimum distribution of $25,000 each. For simplicity, let's assume they have no above-the-line deductions, resulting in an adjusted gross income of $287,500. Since they do not itemize their deductions, they take the standard deduction of $32,300, which is $29,200 in 2024 for married couples filing jointly, plus an extra $1,550 each because they are both over age 65. This brings their taxable income to $255,200 with a total tax liability of $46,709. Now let's say John and Jane decide to donate $50,000 in cash to a qualified charity. To show you the tax impact of this donation, I need to go ahead and create a new scenario first. What I'm going to do is to make a copy of my previous scenario so all our inputs and financials remain unchanged. And rename it to 50K cash donation. Since $50,000 is less than 60% of the adjusted gross income, the entire $50,000 is deductible. To show you this, I will go ahead to Schedule A and type in the $50,000 cash donation to 50% limit organization. As you can see, the software indeed confirmed and verified that $50,000, the entire amount, is fully deductible. This time, John and Jane will be using itemized deductions because $73,000 is more than the standard deduction of $32,300. This $50,000 cash donation reduces their taxable income to $214,089, resulting in a lower tax bill of $37,037, or about 21% less in taxes. Not bad at all. Now let's see what happens if they donate $50,000 in stocks that have appreciated from an initial value of $10,000. To show you the tax impact of this donation, I will go ahead and make a copy of my previous scenario so all our inputs remain unchanged, and rename it to $50,000 stock donation. When donating appreciated securities to 50% limit organizations, the deduction is limited to 30% of adjusted gross income. Since their $50,000 donation is within this limit, they can deduct the full amount. To show you this, I will go back to Schedule A and remove our $50,000 cash donation and reflect $50,000 stock donation to a 50% limit organization. As you can see, the software has calculated that the full amount of $50,000 is deductible. The income tax impact of this donation is the same as with a $50,000 cash donation. This $50,000 stock donation reduced their taxable income to $214,089 and kept the tax at $37,037, the same as with the cash donation. However, there is an added benefit. John and Jane avoid paying capital gains tax on the $40,000 appreciation, and they also avoid paying the 3.8% net investment income tax because their modified adjusted gross income exceeds the IRS limit of $250,000. Essentially, by donating appreciated securities instead of donating cash, John and Jane saved up to $7,500 in capital gains taxes, assuming 15% long-term capital gains tax rate, and in net investment income tax. To show you that, let me go back to Schedule D and adjust their long-term capital gains. So they previously had $20,000, but they sold their securities for $50,000 with cost basis of $10,000, resulting in net $40,000. $40,000 plus $20,000 equals $60,000 in new capital gains. This automatically increased their adjusted gross income by $40,000. But before I show you the impact on their taxes, let me go back to Schedule A and remove their $50,000 stock donation and reflect $50,000 cash donation. As you can see, the software calculated that the full amount of $50,000 is deductible. Now let's take a look at the tax impact of this action. By selling their securities and donating cash, John and Jane increased their taxable income to $254,089. This also resulted in a higher tax liability of $44,557, or about $7,500 more. The conclusion we can make from this is the following. If you have appreciated securities, do not sell them and donate cash. Instead, donate appreciated securities directly to a charity. By doing so, you will get tax deduction and will also avoid paying capital gains taxes and potentially net investment income tax. Now, before we move on to our fourth scenario, let me quickly restore the numbers so we remain consistent with our scenarios. I'm also going back to long-term capital gains and adjust them down to $20,000. Now, let's consider a qualified charitable distribution in the same amount of $50,000. To show you the tax impact of this donation, I'm going to make a copy of my previous scenario and rename it to $50,000 QCD. Since John and Jane are over 70 and a half, they can make a qualified charitable distribution from their IRA directly to a charity. This would have set their required minimum distribution, excluding $50,000 from their taxable income. But keep in mind that they do not take a deduction for QCD, as this would count as double dipping. Instead, the QCD reduces their adjusted gross income. Let me show you the impact of this. The first thing that I need to do is to go back to Schedule A and remove any previously made charitable contributions, because this time we are making a donation via QCD. Now I'm going to go back to the IRA worksheet, and instead of taking a $25,000 IRA distribution, each of them is going to make a $25,000 qualified charitable distribution. As you can see, the software has already calculated some decent tax savings for them. The beauty of a qualified charitable distribution is that it directly reduces the adjusted gross income. So in this example, you can see it went down by $50,000. Since we cannot take a deduction for a qualified charitable distribution, this time John and Jane will have to take the standard deduction in the amount of $32,300. The standard deduction and the qualified charitable distribution in the amount of $50,000 brings down their taxable income to $205,200, reducing their tax bill to $33,656, which is about 28% less compared to not donating at all, and about 9% less compared to cash or appreciated security donation. As you can see, the QCD strategy offers a larger tax benefit compared to cash or stock donations. This doesn't mean that donating appreciated stock is always worse than a QCD, but under current rules, QCDs generally provide a bigger tax impact because they directly lower adjusted gross income, unless you have a lot of other deductions. Another benefit of QCDs that I want to show you is the potential for higher medical expense deductions. Let me go ahead and add $20,000 to John and Jane's medical expenses. As you can see, they almost immediately received almost $2,200 in tax deductions. This happens because medical deductions are based on a percentage of adjusted gross income, and lowering adjusted gross income makes more of these expenses deductible. This can be especially helpful if you itemize your deductions, as this can reduce your tax bill even further. These examples show that the type of asset you choose to donate can have a significant impact on your overall tax savings and charitable impact. From a tax standpoint, donating appreciated securities or making a qualified charitable distribution from an IRA can often provide the most significant benefits. As we've seen, donating appreciated property can maximize the deduction and minimize capital gains, while qualified charitable distributions can lower your taxable income directly, which can be especially beneficial for those in higher tax brackets, those who do not itemize deductions, or seeking to avoid Medicare premium surcharges. Knowing how these strategies work enables you to make more impactful charitable donations while optimizing your tax savings. Remember, the difference in tax treatment could mean thousands of dollars in potential savings or missed opportunities. Make your charitable giving count by choosing wisely. That's it for today. If you liked the video, please give me a thumbs up and subscribe to my channel. And if you'd like to learn more about how we help our clients in protecting their wealth and maximizing the lasting impact of their legacy, be sure to visit us at www.lestna.com. Thanks for watching.